Textron's Q2 2026 earnings are officially out, and they actually beat consensus on the bottom line today.
Yeah, they really did.
Top-line revenue came in at $3.8 billion, which is a 3% increase year over year. On the bottom line, GAAP earnings per share hit $1.42, and adjusted EPS came in at $1.62.
Right, which is a solid bump up from the $1.55 we saw this time last year.
Exactly. And management followed up instantly by reiterating their full year 2026 guidance. So they're holding firm on that adjusted EPS range of $6.40 to $6.60.
And they're also projecting manufacturing cash flow before pension contributions to land somewhere between $700 million and $800 million for the year.
Right. Though, I mean, despite the earnings beat, the stock actually traded slightly down this morning, which tells you Wall Street saw something they didn't like.
Yeah, the market is definitely looking past the headlines on this one.
Okay, let's unpack this, because
Yeah.
if you're an investor just looking at those headline numbers, you're seeing, steady, predictable growth. You look at the top line, and Textron saw revenue growth across every single manufacturing segment this quarter.
Literally all of them.
Aviation, Bell, systems, industrial, they all grew. But when you actually peel back the layers of this specific release, you find some really severe margin compressions, a massive strategic divestiture underway, and frankly, a glaring binary funding risk hanging right over that reiterated guidance.
Yeah, the contrast between the headline revenue and the underlying mechanics is, well, it's staggering this quarter.
It really is.
It's a classic case of the income statement telling you what happened, but the cash flow statement, the footnotes, telling you how and why it happened. I mean, top-line revenue growth always looks great on a press release, but you don't take revenue to the bank.
Right, you take profit.
Exactly. And the translation from revenue to profit this quarter was incredibly messy. Consolidated segment profit was $353 million. Technically, that is an increase from last year, but only by a razor-thin 0.3%.
Wow, yeah, so revenue grows by 3%, but your profit grows by less than a third of a percent.
It's a glaring margin problem.
Yeah. And that massive disconnect between the revenue flowing in and the profit actually materializing is it's most obvious in Textron Aviation, right, which is by far their biggest revenue driver.
Oh, absolutely.
Let me throw these numbers at you, because on the surface, they make no sense. Aviation revenue was $1.54 billion, which is up $22 million from last year. And they're sitting on this absolute mountain of a backlog.
Full $8.0 billion in orders.
Right. Demand is red hot. People are waiting in line to buy these aircraft. But then you look at the segment profit, and it actually dropped 3% down to $165 million.
Yeah, pulling their profit margin down from 11.2% a year ago to 10.7% this quarter.
So I have to push back on this. You have growing revenue. You have an $8 billion backlog. How on earth is the profit slipping backward?
Well, what's fascinating here is the mechanics of what we call a delivery mix shift. You have to remember that, not all aircraft are created equal when it comes to profitability.
Okay, fair.
In the second quarter, aviation delivered 40 jets. That's a significant drop from the 49 jets they delivered in the same quarter last year. But at the same time, their commercial turboprop deliveries jumped up to 44, compared to just 34 last year.
So they essentially swapped out higher-end jet volume for commercial turboprop volume.
Exactly.
But they're still selling metal, right? Does swapping one type of plane for another really destroy the margin that much?
It absolutely does, because the fixed overhead of running a massive aerospace plant doesn't change, but the unit economics of what you roll out the door do. The decrease in volume was heavily concentrated in those lower Citation jet deliveries.
And those are the high-margin ones.
Right. Those flagship luxury jets carry incredibly high margins. When you deliver fewer premium jets and more turboprops, your top-line revenue might hold steady because you're still charging millions per airframe.
But the actual profit you capture per unit is just much smaller.
Exactly. Think of it like a car dealership. If they suddenly sell way fewer fully loaded luxury SUVs and replace them with compact sedans, total cars sold looks fine, but the profit pool shrinks dramatically.
That makes total sense. And beyond just the price tag of the planes, the sources point out this volume shift was actively compounded by manufacturing inefficiencies.
Yeah, that's a big piece of it.
Because a factory line isn't just a dial you turn up and down. When a massive facility has to adjust its cadence, slowing down the tooling on one jet model while trying to ramp up labor on a turboprop model, it creates physical bottlenecks.
Workers are waiting on parts, tooling has to be recalibrated.
Right, and all that downtime burns cash, dragging the profit down further.
It's a crucial point. Honestly, the saving grace for aviation this quarter The only thing that prevented margins from completely collapsing was lower warranty costs.
Oh, interesting. So fewer post-delivery repairs on their dime.
Exactly, which provided a buffer against that brutal jet volume drop.
To be fair, though, looking forward, the product pipeline does have some bright spots that could theoretically fix this.
Mm.
We saw the new Citation Ascend really start to scale this quarter.
Right, the first 5 of those aircraft officially delivered to NetJets.
Yeah, and the Gen 3 light jet development programs are pushing right along toward FAA certification. The M2 Gen 3 has now officially joined the CJ4 Gen 3 in flight testing. So they are actively putting the next generation of high-margin hardware in the sky.
Which they absolutely need to do. Because if you think aviation was just an isolated incident of a messy supply chain, you'd be wrong. We saw this exact same revenue up, profit down paradox hit their helicopter business too.
Oh, right. Let's talk about Bell, because their numbers are just as contradictory. Revenue at Bell is up a very solid 6% to $1.07 billion. But once again, segment profit went the other way.
Down 6% to $75 million.
Yeah, squeezing their margin down from 7.9% to 7.0%. Now, here's where I get confused. Commercial helicopter deliveries were actually up 13%.
Yeah, 36 choppers compared to 32 last year.
So if commercial deliveries are up and top-line revenue is up, why is the profitability sliding backward here too?
Because the revenue bump at Bell wasn't driven by those commercial helicopters.
Yeah.
It was almost entirely driven by the military side of the house.
Okay.
They saw a $47 million increase in military revenues, driven by higher volume on H-1 production and the early stages of the MV-75 program.
I see.
But here's the catch with defense contracting. Military contracts, especially in the early production or ramp-up phases, carry vastly different margin profiles than established commercial sales. The profit drop was specifically attributed to program performance and the mix of those military contracts.
Let me make sure I'm translating this correctly. Just like aviation suffered because they switched from high-margin jets to lower-margin turboprops.
Right.
Bell suffered because they're heavily shifting toward complex military hardware that hasn't hit full scale yet.
Precisely that. When you're scaling up next-gen military hardware, margins are incredibly tight. You're dealing with a steep learning curve on the factory floor, expensive new supply chains, and contract structures that don't pay out massive profits until full-rate production.
That sounds incredibly expensive.
It is. The only reason Bell's profit didn't look worse was due to lower R&D costs. As they move into initial production on some of these platforms, internal research expenses finally drop off.
Which makes sense.
In fact, a massive milestone for Bell this quarter was completing the first 2 MV-75 Cheyenne wing structures. The metal is finally coming together.
That transition from paying for R&D to actually getting paid for production is huge for a defense contractor. But before we get to the massive corporate structural changes, we have to talk about Textron Systems.
Oh, yes. Systems is operating on a completely different planet right now.
They were the only segment where margins actually expanded. Revenue came in at $347 million, a 7% increase. But unlike aviation and Bell, their profit surged by 10% to $44 million.
Pushing their profit margin up to an incredibly healthy 12.7%.
So what is the mechanism driving that kind of synchronized top and bottom line growth when the rest of the company is struggling?
It comes down to 2 specific growth drivers. First, armored land vehicles. Production officially began on the Mobile Strike Force vehicle program, which gave them a clean revenue catalyst.
Nice.
Second, and this is a really interesting part, they saw higher volume in military training and support services, specifically driven by ATAC, the Airborne Tactical Advantage Company.
I want to pause on ATAC for a second because the business model here is just brilliant.
It really is.
Textron Systems is basically running a private air force that acts as the bad guys so military fighter pilots can train against them. It's like a software company that finally finished building its app.
That's a great analogy.
They paid for all the heavy development years ago, and now providing those flight hours is highly scalable. The revenue flows in, expenses stay low, and the profit margin just naturally widens.
It's incredibly efficient.
Right.
But, while Systems is quietly printing money, management is making moves that are going to fundamentally change the entire identity of this company.
Here's where it gets really interesting. We've just walked through all the operational segments, but the biggest news in this entire earnings report isn't about what Textron built. It's about what they're getting ready to sell.
Yeah, Textron has officially initiated a sale process to offload its entire industrial segment.
Which is a monumental shift. For decades, Textron has been this quintessential multi-industry conglomerate. The industrial segment makes everything from Cotex automotive fuel systems to EZJO golf carts.
It's a massive piece of the pie.
It is. Let's look at industrials numbers for True 2. Revenue was $848 million, up 1%. Profit hit $59 million, which is a 9% increase, bringing their margin up to 7.0%. The Cotex division alone saw revenue increase by $17 million on a new pentatonic battery enclosure award. So they're successfully pivoting into the EV market. The segment is profitable, margins are up. Why on earth sell a profitable division right as it secures new contracts?
Because that 9% profit increase is, well, it's largely an illusion.
Really?
Yeah, if you look closely at how they achieved that margin expansion, it wasn't driven by a sudden surge in people buying golf carts. It was driven by higher pricing net of inflation.
Okay, go on.
And tucked into that pricing detail is a massive regulatory windfall. It's the recovery of tariffs that were previously imposed under the International Emergency Economic Powers Act, or IEEPA.
Stop right there, because this is the exact kind of detail that is buried in financial footnotes but explains so much. Explain the mechanics of this tariff recovery.
Sure. So the IEPA tariffs were essentially government fees Textron had to pay in previous quarters to import certain goods. They paid that money out, which hurt their margins in the past.
Makes
In Q2, the government essentially refunded those tariffs. Textron got a check back. That's a one-time cash and profit injection.
Oh, I see.
It instantly boosts the margin for this specific quarter, but it is not a structural, repeatable operational improvement. Next quarter, there's no tariff refund coming.
So when a potential buyer looks at that 7.0% margin, they're going to strip out that tariff recovery to see the true, much lower underlying profitability.
Exactly. Management is essentially trying to sell at the top using this one-time bump to make it look as attractive as possible.
Wow. But the divestiture of industrial isn't the only massive structural change here. If you dig further into the segment reporting footnotes, there's another major realignment.
Yep, the aviation segment.
Right, the aviation segment, which was supposed to be their dedicated hub for electric flight, is being completely dissolved as a standalone reporting unit.
Effective the beginning of fiscal 2026, it ceases to exist.
Hmm.
The underlying companies aren't vanishing, they're just being aggressively absorbed into the legacy business.
So Pipistrel goes to aviation, military drones go to systems, and R&D goes to corporate.
Exactly. It signals a management team that is hyper-focusing on its core identity. They no longer want to be a sprawling conglomerate where golf carts subsidize jet engines.
They're rapidly turning into a pure-play aerospace and defense contractor.
Yes. And that strategic shift makes our final topic incredibly urgent. Because if you shed your commercial buffers to be a pure defense player, your entire survival depends on how you manage your supply chain cash flow.
And more importantly, how the government funds our contracts. Which brings us directly to the cash flow statement. Because honestly, this is where the flashing red lights start going off.
Oh, absolutely.
We mentioned at the beginning that management reiterated their full-year guidance, projecting manufacturing cash flow to be between $700 million and $800 million. But in Q2, that cash flow metric plunged. It came in at just $154 million.
Down from $336 million in the second quarter of last year.
That is a catastrophic year-over-year drop in actual liquidity. What is draining the cash?
When you trace where that cash went, you find it physically sitting on the factory floor. The cash flow statement reveals that inventories were a $157 million use of cash this quarter.
Wow. So they spent $157 million buying raw materials and paying workers to build products that haven't been delivered yet.
Exactly. In the same quarter last year, inventory only consumed $101 million. So the inventory build is rapidly accelerating, tying up massive amounts of working capital.
And on top of that, their capital expenditures increased to $95 million this quarter, up from $78 million.
Right. They're spending more on facilities, and they have more cash trapped in unsold inventory.
Okay, hold on. Their operational cash flow just got cut in half year over year. Yet, despite that massive liquidity squeeze, the company still went out and returned $209 million to shareholders by buying back their own stock this quarter.
Yeah, they did.
How does a company justify buying back $209 million in stock when they only generated $154 million in cash from their manufacturing?
It is an incredibly aggressive capital allocation strategy, and it means they are actively drawing down their cash reserves to fund those buybacks. Now, to be fair, they still have $1.4 billion in cash equivalents sitting on the balance sheet.
So they aren't going bankrupt tomorrow?
No, but the trend line of that cash conversion cycle is tightening significantly.
And that tightening makes their forward guidance incredibly precarious. This raises an important question. If cash is already tight, how can they confidently reiterate that they'll hit $700 to $800 million by the end of the year?
Well, this is the biggest risk in the entire earnings release. In the Outlook section, management included a massive caveat regarding that guidance. They stated flatly that their current outlook assumes the receipt of additional fiscal year 2026 funding for the MV-75 Cheyenne program.
Ah, okay.
And they were relying on getting this funding through something called an above-threshold reprogramming request.
Let's translate that mechanism for you because above threshold reprogramming is deep Pentagon bureaucracy speak, and it's vital to understand.
It really is.
The DoD operates on strict budgets. The money Textron needs to finish out the year on the MV-75 contract was not in the original budget. So, the DoD has to actively ask Congress for permission to take money from a completely different program and move it into the MV-75 pot.
Exactly. Congress has the ultimate power of the purse. The DoD cannot just write a check. It requires explicit congressional approval, so it's a request, not a guarantee.
So what does this all mean for the retail investor listening right now? What happens if we hit political gridlock and Congress doesn't approve that reprogramming request before the end of the year?
Management laid out the hard numbers of that exact worst-case scenario. If that congressional funding falls through, Textron's adjusted EPS could take a 20 to 30 cent hit.
Ouch.
But far more critically, their cash flow could be slashed by $150 million to $250 million.
That is $250 million in cash flow resting entirely on a congressional committee saying yes to a reprogramming request.
It's a massive binary risk hanging directly over the second half of the year. If they get the funding, the guidance holds, and that $157 million inventory build converts into a wave of cash.
But if Congress stalls?
If they stall, Textron incurs significant unreimbursed costs. Their cash flow guidance collapses entirely, and suddenly, those $200 million stock buybacks look incredibly reckless.
It is the ultimate tightrope walk for the back half of 2026. You have a company executing reasonably well on top-line revenue, managing an $8 billion backlog, and physically bending metal on next-gen military hardware.
Right.
But they're doing it while navigating internal margin compressions, fundamentally restructuring their corporate identity by selling off the industrial arm, and literally waiting on Congress to clear a $250 million check just to meet their own projection.
Yeah. And if we connect this to the bigger picture, it leaves you with a fascinating reality to monitor as an investor. What's that? Well, with the industrial segment actively on the chopping block and aviation dissolved, Textron is rapidly transforming from a classic diversified conglomerate into a highly focused, pure-play aerospace and defense contractor.
Yeah, that's true.
So you have to ask yourself a fundamental question. Are you currently valuing Textron for the sprawling, insulated industrial company it was, or are you pricing it for the streamlined, defense-heavy, highly cash flow-sensitive company it's about to become?
That is exactly the question you need to be asking yourself as we head into the second half of the year. And that's why you have to look past the headline revenue and dig into the footnotes.
Absolutely.
If you want to keep cutting through the noise of earnings season and finding the actual story hidden in the cash flow statements, make sure you follow the show. We are covering the markets daily, bringing you the mechanics and the insights that actually matter. We'll catch you on the next one.